The market is getting smacked around like a nerd in a 1980s movie. Here's what you need to do now. Hi everyone, I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This has been a tough year for the markets. The S&P dropped 25% between the beginning of the year and June, and it rallied strongly through mid-August, but has resumed falling in the past 2 weeks. When this type of market action occurs, it's very natural to get frozen in fear. Investors stop looking at their accounts because they're afraid of what they'll see. Pain. Look, I love stocks. I love investing in them, writing about them, and making funny little videos about them. But as much as I love stocks, I'm invested in other things as well because it's the smart thing to do. Diversification is very important.
You need to diversify your bonds.
Yes, the RZA from Wu-Tang Clan got it right. You do need to diversify your bonds, your stocks, and your entire portfolio. Being too overweight in any one asset class like stocks or even any one sector like technology is a good way to lose a lot of sleep when things go wrong. We've all been in the position of owning too much of that one investment that goes south, and that sickening feeling of being unsure what to do and how to escape the situation without a giant loss can be paralyzing. Diversifying your portfolio means some part of it should be working even when stocks aren't. If stocks are falling, you're still generating income from bonds and you're not losing money, which is important when everything else is falling.
The sky is falling!
For example, according to Vanguard, during the global financial crisis, stocks fell an average of 34%, yet investment-grade bonds returned more than 8%. And during the COVID crash in 2020, when stocks fell an average of 16%, bonds held their head above water, returning 1%. In fact, between 1988 and 2020, during months when stocks were down, bonds were up 71% of the time. Some real estate, precious metals, and other commodities can also help smooth out those rough patches in the market. Now, the Oxford Club's asset allocation model suggests holding 60% of your assets in stocks, 30% in bonds, and 5% each in precious metals and real estate. That way, something will likely always be zigging when the rest of the market is zagging.
I think you zigged when you should have zagged on that page.
And not having all of your investments in one type of asset will help you sleep better at night knowing that your nest egg and your neck are protected.
Yo, you best protect your neck.
If you want to learn how you can further protect your neck, generate solid income with the opportunity for growth as well, away from the stock market, click the link in the description below. Thanks for watching State of the Market. I'm Mark Lichtenfeld.
Straight from the Brooklyn Zoo.